My name is George Lagares. I'm Chief Economist at Forvis Mazar. I am joined by James Rollinson, our Senior Investment and Portfolio Manager. Um, so let's get right to it. And before the usual death by PowerPoint, let's just talk about the big issues. Um, it's not just one. It's two issues that are right now front and center. The first one is, as you would expect, Iran. The second one is a brewing private credit issue. I'm not saying crisis issue that's emerging in the United States. So we'll touch upon these both. Let's first talk about Iran. One thing that's clear in our minds, this is a geopolitical externality for markets, right? This is not something that results from a market malfunction, which is usually a good thing. Okay, markets are trained to handle externalities. Financial markets, capitalist markets, have operated very well and often gained, even when there is a war on. Wars have been a consistent feature in human history. Capitalism has been around for about 400 years, 450 years. So capitalism is very well positioned to handle wars. So the problem is not the war itself. The problem is the closure of the Straits of Hormuz. Now, I'm sure you've all heard it a few times on TV, but let me repeat the numbers. Roughly 20% of global oil goes through there. Um, Oil is not just used for cars and trucks. It's primarily used for transportation, 80% of it. Unlike what some people think, it's not used for factories, to produce energy, especially in the Western world. Only a few Middle Eastern countries use oil to fuel their own factories. Um, and around 20% of it is used on in virtually everything else. Everything that has plastics on it, clothes, oil goes into a lot of things. Okay, so this oil shock is immediately not um, not uh, sorry via third parties affecting the whole of the supply chain. Now, I use the word shock. At this point, we are looking at a shock. We're not looking at a crisis. And it's very important that we separate the two. A crisis is an ongoing thing. We think, and it's our view, that the closure of the Straits of Hormuz, not the war, which could last for longer than what we might think, but the actual closure of the Straits of Hormuz is a matter to be resolved within weeks. Quite frankly, even in our internal meetings, there is a sense of surprise and frustration that forces that engaged Iran were surprised that Iran closed the straits, as this was the one card Iran had to play. So where we had expected there would be operational plans to address this, they seem to have been caught somewhat off guard. And that sort of postpones the solution. But it's our core thesis that the Straits of Hormuz, for lack of a better phrase, are too big to fail. They're too big to close. The impact from a multi-month closure of the Straits of Hormuz could be extreme for the global economy. So we think that ways will be found, be it through the diplomatic avenue, which we all hope is the case, or through the military avenue. Now, we're not going to explore scenarios in this webinar. Frankly, we wouldn't have the time. And B, most important, James and I are both financial analysts, and we don't want to play the role of the armchair general. So let's see what this means. Next slide, please. Yeah, and thank you, Leona. So let's take a step back and talk about the three themes that have defined our outlook. The three Ds: debt, disruption, and deregulation. We're going to focus on the two first, the debt and disruption. Um, in previous crises, you would see people running to bonds for safety. This time around, we see bond yields spiking. The bond market has been weak coming into this. Okay, it's been weak for several reasons, and an uncertain inflation outlook for one, but also de-dollarization, the sell America trade. Um, so, and of course, very high debt, which tends to weaken markets, right? So debt is now, and fixed income are now an issue. And I think James is going to touch upon this a little bit more when he talks about portfolio. It's a weaker market than it used to, and that's why you don't see people running into bonds at the first sign of trouble. The other one is disruption. There's no clear way to put it that high debt creates a lot of demand for action from governments, and governments have to respond somehow. And when governments fail to respond, they may elect populist leaders, which leads to geopolitical fragmentation and thus geopolitical disruption. Add to this a completely separate item, which we're not going to touch upon this webinar. It's AI, which is already disrupting the economy, by the way, in ways we cannot yet quite understand. Okay, so the world is ripe for disruption. And if you have a portfolio, or if you have a small business, or if you're just simply interested in global affairs, what you should know is that this is going to be a volatile world. This is going to be a disrupted world. Also, this is the norm. Okay, and it's interesting that we say it because I'm 47. James is somewhat younger, not as much as you'd think. And we both grew up in a world that was relatively stable. We both grew up in it at a time of what is known as the Great Moderation. Okay, which meant low macroeconomic instability, mostly because central banks were active in managing the economy and globalization was keeping inflation low. Now there is an anti-globalization wave that's destabilizing globalization. And as we said, there is geopolitical and geoeconomic disruption, but this was the norm maybe 20 or 30 years ago. And it is important to go back to the first thing that we said. Markets are no stranger to this. What seems to us like an extraordinary set of circumstances and events. Actually, financial history has a lot of example of financial assets even outperforming in markets where there is high uncertainty. In markets where there is high uncertainty, um, good asset allocators and good fund managers get to prove their mettle. They get to prove their expertise. Okay, if the markets are not volatile, then we're all in the same boat going upwards. It seems calmer, but ultimately, people might be paying a lot of fees for average or below average managers. Okay, so it is a good thing to remember this is a good market. It's not a bad market. It's a volatile market that's not experiencing an endogenous crisis. It's a volatile market. Yes, it makes people feel anxious, but at the end of the day, and as you will see, stocks have very slightly moved from their all-time highs. They've barely entered the correction territory, not the US ones, the European ones. So the point I'm making is that Iran is a thing. It is not the thing that's going to destabilize markets and lead us into a new 2028. I would argue not even a new 2022. Now, next slide, please. This should come as no surprise. This is the traffic in the Straits of Hormuz, which has fallen down to zero. The chart is a couple of weeks old. I was tempted to update it for this morning, but it still shows zero. So it hasn't really moved. There are some unconfirmed reports about tankers going through, mostly mostly of Iran's shadow fleet and headed towards China. I would tend to believe some of those reports, but global oil isn't flowing. Okay, not in places that they would certainly help Europe and the UK. Next slide, please. Now, before this whole debacle, um, we were wondering where did inflation go? Trade wars were supposed to bring up inflation, especially in the US. But the US was fortunately benefiting from some kind of a deal between themselves and Saudi Arabia to keep oil prices in the 60 to 70 range. Just before the war, oil prices were around 60. So year on year, they were still negative, and we expected the year on year effect to be over by April or May. Now, also, those who feared inflation were at least calmed as they saw the Chinese economy not growing very fast. Just very recently, they lowered their target from 5% to 4.5%. Um, and the important thing to remember here is that you had these two deflationary forces that were helping. Now, what's changed? One, China is paying anywhere between double and 10 times more to get its oil from Iran. So this is one. Okay, and that is not even showing up in producer prices, which are now a negative 1%, uh, up from a negative 3.5 to 4%. So China is deflating the world a lot less. So it will show up in the numbers in the next few months. Um, and it will already start showing up again in the next couple of months if we see the energy component of our own inflation. So China is deflating less, and obviously we have an oil shock to contend with. Okay, again for comparison reasons, in 2022, global oil prices nearly tripled. Okay, so we're not anywhere near there yet. Okay, and that was also the case in the 70s. Okay, so keep that in mind. This is a shock. It's not a crisis, not just yet. And there are strategic reserves precisely for that particular scenario. So we anticipate that this will have an effect until the end of the year, but in our base case scenario where the issue of the Hormuz Strait gets resolved in the next few weeks, probably not much beyond that. Next slide, please. Now, back to this point, you hear sometimes the pundits and the TV channels screaming, "Oh my God, oil's at 100. Okay, we're all doomed." Oil was at $100 from nearly all the time from January 2011 all the way through to July 2014. Okay, that's 21, 22, 23, and sorry, that's 11, 12, 13, and half of 14, 3.5 years. Yet inflation stayed at around 2%. When I have a 400 pound budget every month, and I spend £100 in oil and £300 in the supermarket for gas, and £300 at the supermarket, and then suddenly I see a 50% jump in my energy bill. The thing that I will do is most likely reduce expenditure, discretionary expenditure elsewhere. Okay, this is a very simple concept. That's why we need to remember that energy inflation doesn't instantaneously become headline inflation. Okay, consumers themselves have ways of regulating it. It's a question, of course, if countries will want to take some of the burden away from consumers self-regulating and say, here's some more money to get you through the month. In my humble opinion, any measures taken should be short term. and concomitant to a shock, not a crisis, because long-term measures, a lot of money handed out to consumers at a time when energy inflation is spiking, could lead to a larger inflation problem, the likes of which we saw after the pandemic. Um, Next slide, please. Now, going into this, and this is also important to remember, we had the trade war. And the American companies, they were starting to pass inflation onto their consumers. This is your green line. Okay, it is prices paid according to a survey we call a PMI survey. But they ask purchase managers how much did you pay this month versus the previous month, essentially. Anything above 50 is expansion. Anything below 50 is contraction. So if you see this number at the 70s, it means you had a very sharp expansion. Okay. Manufacturing was booming, but it was paying also a heavy price in input costs. That was ready to go into the consumer inflation numbers. Okay, so add to this the shock from oil, and you can see how now it's all piling up. Again, the problem for me is not Iran, it is the backdrop that has been significantly weakened by the trade war. Okay, from an economic perspective. Next slide, please. Now, good news is that financial markets are not pricing in long-term inflation. This is a highly technical chart I won't bore you with, called break-evens. It's a calculation. We take bonds, we look at bonds, and we see what sort of inflation they're pricing in. Now, short-term bonds, the 1 year, as you see, are pricing in 5% inflation. So that's a short-term effect. But and long-term, mid and long-term bonds, 5 and 10 years, they don't price in as much inflation. I mean, the 5 year numbers have just barely budged right now, which is something we're looking at. Now, this is important because central banks don't tend to act unless they see inflation, as they call, de-anchored, inflation expectations de-anchored, i.e., they hope that markets and consumers will not believe that inflation is coming, because then they will act like inflation is coming, buy ahead of time, make big purchase decisions ahead of time, and that could cause inflation to spike, which would force them to react, which means hike interest rates. This chart tells us that they're less likely to hike interest rates right now, be more data dependent and wait. Next slide, please. Now, this chart is, we have to show it, but it's unreliable to be honest. This is rate expectations for until the end of the year. Presently, US bond markets are pricing in roughly one rate hike until the end of the year. The UK bond markets are pricing in nearly 1% rate hike until the end of the year. That's 1%. Sorry, so four rate hikes. And the EU is pricing in 3 to 4 rate hikes. Now, before this whole thing began, markets were pricing in 3 rate cuts in the US, 2 rate cuts in the UK, and no rate cuts in the EU. The whole rate expectation curve moved about by 1% across the board until the end of the year. Now, this is not where we think things will go. That's important. This is where bond markets are positioning themselves. But saying we look at bond market positioning to infer inflation is to infer interest rates is sort of like saying, okay, if stocks go higher, then earnings will likely go higher too, which is not always necessarily the case. That just shows some dislocation in the bond market. Our present view is that no hikes, no cuts across the board yet. Central banks will be data dependent and wait. Okay, now this is not a very high conviction call. Things are very fluid, and we could change that opinion, obviously. So I'm putting a big asterisk there. But currently, our thesis is that we won't see movements from central banks or indications for movements until the next couple of months, until we see how this whole thing has affected the real economy. Next slide, please. Now, because I'm painfully aware I'm eating into James's time. Um, At the same time, the second issue we're looking at, and I'll keep it much briefer, is a private credit issue. What's private credit? Non-bank lending, essentially. And why is this important? We have banged the table on this for some time, but really we didn't know how this was all going to unfold. So very briefly, after 2008, we shackled the banks and we told them you can't lend so much money anymore. But somebody needed to lend to companies, and they said, fine, private investors can do it. Nobody's shackling them. That's why you had a very sharp expansion of the private equity and the private credit market. Now, the problem with these is that they boomed at the time of very low interest rates, but then inflation came after the pandemic and interest rates started to go up. So that model was disrupted. Um, Also, banks are now re-entering the lending game. They have a lot more competition, which means they are entering at higher multiples than previously, and they're exiting at lower multiples than previously. And their model is challenged. And because their model is challenged, valuations have gone down. And more important, as some of the worst positioned companies began to falter, Tricolor and First Brands at the end of the previous year, we saw the first shakeup of the system. Now, by March, a few big companies have essentially barred or gated their redemptions from investors. By the way, we don't own any of this, so please don't be worried. Okay, we're describing the bigger problem here, which means that investors can get their money back maybe at a future date, or it will take a long time for them to get their money back. This is, again, it has echoes of 2008, and we get it, but it's more a liquidity issue. They sold something that was illiquid to retail investors that want their money today. So the worse the headlines get, the more redemption requests, the more they're forced to bar gates so that it will not hurt the rest of the investment as they need to do fire sales, and they will not hurt the investors that are actually sticking with them. And it's all part of covenants that were there when people were signing their investments. Um, it's not a crisis, not by a long shot yet. We estimate roughly 250 billion assets in danger. Um, and the Fed can has many ways to print money and stop contagion, even if it needs to hike interest rates. That's what did in 2023 when it funneled money to US peripheral banks, even as it was hiking interest rates. Okay, so we don't see a crisis, but it is something certainly we're monitoring. Why? Simply because it has those 2008 echoes, and we never want to be surprised. So we're closely monitoring it. We're discussing it every day. The endogenous nature of this problem is something that we talked a lot about. We reached the conclusion that we're not near a crisis, just a new financial crisis, but definitely an area to watch. So we're doing this, and that's what all we're doing right now. We're watching, and we're not changing our asset allocation because of this. Next slide, please. This is exactly basically what I just said in the chart. This is business development companies, as they say, that trade on this private credit, and currently they're trading at about 75% to their stated value, their net asset value, as it's called. Okay. In times of crisis, they've traded as low as 30 and 40. So the 75 does not single crisis, but it is significantly below the average. So that merits watching. Next slide, please. And here is the 15% worst case default rate, which the default rate which would possibly damage those assets. 15% default rate means around 300 billion or less in question that are the assets we worry about. Again, the Fed can cover this very, very quickly. Next slide, please. So here is our thesis, and then I will about both Iran and private credit. Our thesis is that this is a short-term thing. It will affect price at the pump. It will have a repercussion possibly until the end of the year because it's already lasted enough, which has forced us to hike both our oil projections and our inflation projections, and also lower a little bit our growth projections for the world. But again, not a big crisis, and it's pretty much a same view that we have over private credit. Next slide, please. And I will leave you with this. As far as the UK's economy remains weak. The UK's economy remains weak. As you can see, unemployment has been higher at 5.2%. Meanwhile, private wage growth, so not overall, but private, is down now to 3.3%. Okay, so it's barely above inflation. So the economy is weakening. And if you're fearing inflation, that's actually might be good news over the longer term. Over the medium term, you get an energy shock in a weak economy, so not great news altogether. Mr. Rawlinson, I ate up enough of your time. Hopefully, you'll forgive me.
That's not a problem at all, George. Thanks very much. So I'm going to be doing an overview of markets, portfolio performance before the conflict, and how we've positioned your portfolios to both protect in the current environment as well as hopefully rebound well if if the conflict finishes as per our expected timelines. Now, I do have to apologise in advance. I might have a coughing fit halfway through this, so I will try and mute myself if that does happen. So if we can go on to the next slide, please. So markets have been swinging around over the last 2 weeks on any news it can get, on a tweet, on news of whether there's information from the US on some sort of plan, on news that the Iranians are laughing at said plan. We don't really know what's happening. It's the fog of war. So short-term charts do become out of date very quickly, as George mentioned earlier. So what I'm looking to do is really look at the context of performance on a 1-year basis. So what we can see is the blue line at the top is emerging markets, and that's been the strongest performing market really over the last 12 months. And that's really been a story of earnings coming through. If you remember the 2010s, there was no real earnings in emerging markets, so it really lagged developed markets over that period. But over the last year, 2 years, you start to see earnings growth of low to mid-teens in this area, which has really helped performance. And it also started 2026 very well. But obviously, emerging markets are more prone to global shocks. They're also prone to a rising dollar. So what started really well in 2026 has fallen the most. But at the same time, this area is still up around 27% over the past year, which is a very healthy return. Conversely, at the bottom, the two, green and teal lines are bonds. And these have returned slightly below what the yield would have been a year ago, which implies you've got your carry, but there's been a little bit of capital loss, as George mentioned earlier, with those bond market dislocations. And that's, as George mentioned, because of rising inflation expectations and also expectations that rate cuts, there are going to be no rate cuts, and actually we might see rate rises in the next year. What you also see is corporate bonds have sold off slightly more. It's not really apparent on this chart. The two lines are fairly close together, but because corporate bonds have spreads in them, which have also widened, these have sold off a little bit. So there's been no real cushion over the last few weeks from the bond market, and we are underweight this area. And where we do have fixed income, we do have lower interest rate risk exposure. But what has provided a good cushion? Well, that's that black line, commodities, which is up around 23% over the last year. And that's really happened almost all this year. If you look over the course of 2025, it was down to essentially flat. And this is really coming from oil trading around 100. This isn't gold, which, as we've seen over the last few weeks, has really started to trade more as a risk-on asset and rather be a good diversifier. The other thing for gold trading around $100 is obviously we've seen quite a lot of dollar strength as people have moved to what is still the safe haven asset. So oil being priced in dollars obviously sees strength from a sterling perspective. We continue to have a strategic position in commodities as a geopolitical hedge, as we are very aware of how oil can affect multi-asset portfolios when it spikes. In the middle is the dark blue line, which is developed market equities, which I'm going to provide a breakdown of in the next slide. Obviously, this is very weighted towards US equities, which is about 60 to 70% of this, which again has a lot of dollar exposure. So you've seen less of a sell-off overall in developed market equities over the course of this conflict. This asset class is still up a very healthy around 13% in sterling terms over the past year, which is 2 times the long-term average. If we can go to the next slide, please. So this is a breakdown of those developed markets over the past year. At the top in the gold line, I mean, it's very just on top, is Japanese equities, where corporate governance reforms have seen earnings come through. And a bit like in emerging markets, what has performed really well going into the start of this year has sold off an awful lot at the start of this conflict. Now, we were overweight coming into this year, so really enjoyed the outperformance over the last year. We did move to neutral in January, so we've avoided some of that volatility in the past few weeks from Japanese equities. At the bottom is EU equities, and it being at the bottom is a little bit misleading because for me, I have memories over the last 18 months of European equities performing really quite strongly. They benefited an awful lot. I don't know if you've heard of the halo trade, which is heavy asset, low obsolescence trade, this real move into value equities instead of SaaS-like equities over the past 18 months to 2 years. It really benefited from that, as well as really strong performance in the banking sector. But what has, again, it's been hit really hard this year because European equities are really are an awful lot more energy intensive than, say, US and other areas of the world. So that's why that sold off quite a lot. It's still up 75.5% overall, so not a terrible return, but it is below other developed market equities. UK equities have really performed quite well in 2025, and they've also held up well this year. Over 2025, it was really a catch-up trade. UK equities have been cheap for quite a long time. But again, coming into this year, it's performed really well. There's an awful lot of energy and commodity stocks in the UK, which with oil spiking around 100, you can understand why that index has performed particularly well. And then we have US equities, which is the green line. And US equities have really been on an interesting roller coaster ride. In 2025 alone, if you looked at it as a standalone year, actually it would have been at the bottom of the pile. Q1 2025 was a really bad time for US equities. If you remember, markets were starting to price in extra tariffs coming from the US administration, which did happen, which did come into force in April 2025. However, as those tariffs ended up not being enforced in quite a stronger way as was originally advertised, you then saw really strong post-liberation day performance and a tech rally in the middle part of last year in the US. Now, at the same time, I said this was a roller coaster. Coming into 2026, US equities, if you can see the green line, really started to level off coming into 2026 as the tech trade really started to lose steam, as people started to worry about how much spending was going to have to be done on AI in order to make it happen and whether any profits were actually going to come through. But then, as I mentioned earlier, US equities overall have held up relatively well on the Iran conflict. This has been due to, from a sterling perspective, dollar holding up well. They've got energy independence, but also US equities are generally a lot less reliant on global growth than equities in the rest of the world. So there's been quite a lot of dispersion across developed market equities, but they really have been quite positive across the board over the last 12 months. And that does include two big sell-offs, the Liberation Day tariffs sell-off that you can see at the start, as well as the recent sell-off on the recent conflict. So can we go to the next slide, please? And the next slide actually as well. So how do these translate into your portfolio performance? So I'm sure regular people that come on to watch this will be aware that peer performance we can only get to the end of each month. It's available on a monthly basis. So the performance I'm going to present at the moment is to the end of February. I will present some final portfolio performance at the end, which has a bit more of an update in it, but anything with peers in will be on a monthly basis to the end of February. So what we can see here is we have seen strong performance from our portfolios across the board against peers. What is also really apparent is that performance in the first 2 months of the year was really strong on an absolute basis. If you're looking at that adventurous portfolio, 5.6% return is the kind of returns that you expect to see on a 1 year basis for this sort of portfolio. So the reverse that we have seen should be understood in the context that the start of 2026 was a very strong start to the year. If we can move to the next slide. So this is 1 year performance, and I'm going to give a little bit of an explanation of the reason for what has been good performance. So we've been essentially in line in our low risk portfolios with peers, but then as you move into high risk portfolios, there really has been some good marked outperformance across the board. What's behind this? Well, we've been overweight equities versus fixed income. I showed in that chart earlier that equities really have delivered a much larger return than you have seen from bonds. We've also been underweight the US dollar, which has been weak apart from the very recent conflict. So that's been a trade that's worked over the course of 1 year. We also came into the 2025 underweight US equities. This is really the opposite of a lot of peers who came to 2025 overweight equities, and that part of the market really underperformed in the first part of 2025. But then, because we were underweight, we were able to use that ammunition to move back to equal weight and enjoy that rally in the second half of the year, when an awful lot of peers were having to actually cut back their positions when they were worried about incurring further losses. So the time of that trade has really worked to our advantage. As I mentioned earlier, we've been overweight Japan, which has been the strongest developed equity market. And also we've been overweight convertibles, and an awful lot of our peers won't have any convertible bond exposure. It is a little bit niche, but it's an area that we are very comfortable understanding. It's an area that performed very badly in 22, 23, but in the past 2 to 3 years, there's been an awfully large catch-up trade there, which we have benefited from. Further, there have been some changes we made in Q1 that I'll discuss later, where we've tilted away from US mega cap tech to broad US equity exposure. If we can go to the next slide, please. I'm going to talk very quickly here, but just to say the 1 year performance is a continuation of the trend of very strong 5-year performance versus peers, but also on an absolute basis. Some very strong performance here in our portfolios. So now the next slide, please, please, and I'll move on to our positioning. This is just going to be a discussion on positioning on this slide. Then I'm going to discuss how this positioning helps in the current environment. So we do remain overweight equities, which have obviously sold off in the recent environment. But so if you think about it, have fixed income, so has gold to an even greater extent. So a lot of those diversifiers aren't really helping. So that overweight position is not really affecting us so much. And we very much remain constructive on a look-through basis on equities, particularly with the US midterms coming up. We expect the US administration to try and juice the US economy as far as possible. And meanwhile, company earnings and fundamentals do remain robust. Within equities, we are overweight emerging markets, but have no small caps. We're underweight the UK, as George showed earlier. We do have a lot of concerns about growth in the UK and how this will feed through to company earnings there. But we are overweight in the US, which, as I mentioned earlier, has been the market that's really held up the best in the current environment. And there, we're really tilting away from those mega cap tech names where we're concerned about that AI trade. And instead, we've added utilities, we've added equal weight stocks, and we've added some small cap. And I'll touch on that in a moment. Elsewhere in the equity bucket, we do have some exposure, as I mentioned, to energy equities, which have performed very well in the last month or so. And we do have some infrastructure equities, which provide some nice diversification in the current environment. Within fixed income, so we're now moving to the middle of the slide, we are underweight fixed income. And this, as George mentioned earlier, this is very much part of our 3Ds framework. We are particularly worried about the amount of government debt and how this is likely to affect yields and borrowing costs in future. It's also very notable we have no high yields, and we've been talking. George is talking about the private credit issues. Some of that is feeding into yields in high yield. So parking the Iran conflict for 1 second, it also means we are avoiding some of the risks around that private credit issues that George mentioned. At the same time, we are overweight in government bonds, but at the same time, we don't have generic government bond exposure. Here, we are overweight to inflation-linked UK bonds and TIPS in the US. So both of these have a lot of inflation protection. We bought these when inflation was being priced particularly cheaply. It was being priced around 2.4%, which felt mad to us. We have also got significantly reduced duration. So reduced duration means reduced interest rate risk. So when those expectations of interest rates rising are coming through and cause capital loss in bonds, we are experiencing this to a lesser extent. We are still experiencing it. You can't get away from it, but we are experiencing it to a lesser extent. And then within alternatives, we have no gold, and as I mentioned earlier, that gold is really not helping in the current environment. It has sold off 20 to 25% over the past few weeks. It's behaving more like a risk asset. Instead, what we have assets in is an absolute return fund. It was a new asset class that was added in January, and I'll talk more about that in the next slide. So if we can move on to the next slide, please. So I really talked about broad positioning in the last slide, but this slide is just to give an idea, to really talk through how some of that positioning is protecting your portfolios in the current environment. So hopefully you've received the rebalance note in January that explains in more depth all of the changes that we made. But there are also there's changes that we've made, but also existing positions that are really protecting your portfolios. As I mentioned earlier, there's market rotations that have been happening external to the Iran conflict. We have been concerned for some time. I've said this a few times before, but to repeat it again, US tech earnings have really come into question, those companies that are really chasing the AI trade. There's a few issues here. First of all, they have on their balance sheet the chips they've been putting into this AI research, and they've been expecting to have a 5-year shelf life. In reality, the research that we've done suggests that instead they're only going to last about 3 years. So they're going to have to be replaced sooner, and that's going to cost more, and that will eat into earnings. Another concern is that they are going to have to spend an awful lot on energy in order to make this happen. All these servers, all these data centers cost an awful lot of money to run, require an awful lot of energy. And the concern is that the reports that we've read and the research that we've done suggest that they will need to do about 3 trillion in spending over the next 5 years just to make this happen. So they've got to make earnings over the top of that 3 trillion spending. Instead, what we focused on in the US, we still have an overweight to the US, but we're focusing on the average US company, shall we say, that's going to benefit from a US administration which is looking to juice the US economy coming into the midterms, so benefiting from a strong economy. Plus, and to do that, we added equal weight exposure plus some small cap exposure, and as I mentioned, we added some utilities. And utilities are really the picks and shovels trade of the AI AI boom. They're enjoying a really beneficial regulatory environment as both sides of the aisle really want the US to become the AI dominant, and that is leading to earnings growth, which used to be a fairly boring, shall we say, 4%, and now that's moving up to around 8%. They're starting to become much more exciting companies, and the cherry on top is that they are generally cheaper than US companies as a whole. So that's a trade that's done really well this year. US utilities are probably the best performing sector in the US this year, and that's really helped your portfolios to hold up in the current environment. What other changes have we made? We've taken profit on Japan. As I mentioned earlier, that market has sold off significantly, so there's been a lot of volatility there. That performed particularly well, and we've taken profit there in an area that is particularly energy dependent. Finally, the changes that we made this quarter, we added absolute return. So absolute return funds are not affected by market beta. They aren't affected by the direction of markets. Instead, we are picking managers who are trying to add just pure alpha. And we are very confident that the fund we've chosen has two managers who are experts at doing this and have an absolutely brilliant track record of doing so. And so this really has no directional issue at all in the current environment. But what other positions did we have before, which are benefiting your portfolios? Well, as I mentioned before, we have a strategic position in energy equities for these geopolitical shocks. So that's done really well. And then in fixed income, as I mentioned earlier, we have that low interest rate exposure. And where we do have government bonds, we have a lot more in inflation protected securities. So where those inflation expectations have risen, those bonds have done particularly well. So just a final slide now, if we can move on to the next slide. In my section. So this is just a slide to give you an understanding of how portfolios have behaved given the recent news. So this is up to date to March the 20th. We could have kept updating these as more news came through. However, actually over the last week, markets have actually moved fairly sideways. Obviously, there's no peer data here. We don't have that, as I mentioned before. So as you can see on the far right, yes, portfolios are off the highs that they got to in February, about 4, 5, 6%, depending on the portfolio. And high risk models have come off more, as you'd expect. But in the context of in the context of the past 12 months, where we've had two large sell-offs, the Liberation Day tariffs and the recent conflicts, these are still very healthy returns that these portfolios have seen. As I mentioned earlier, we've done a lot of downside mitigation through our position within equities, through our positioning within fixed income, as well as that addition of absolute return and our strategic energy positioning. And finally, we are overweight equities, so we are confident that we are positioned really well should our base case scenario come through, where the conflict lasts weeks and not months. So we're positioned well should we see a recovery rally within equities. So that's the last of that's the last of my slides, and just going on to some final overviews in the next two slides, so the conclusion and Q&A. So just a review of what we've gone through. So the Iran conflict base case is for a resolution, which takes weeks and not months, and a reopening of the Strait of Hormuz. We expect markets to refocus on the medium-term drivers of AI disruption, US trade policy, and the fact that there is going to be quite a lot of US stimulus coming into the midterms. The economy does remain strong, though employment conditions are weakening and inflation risks are growing, as George pointed out. And as I showed, portfolio performance has been robust, with portfolios well positioned in the event of a recovery rally. We will be sharing these slides, so the next few slides are just our cheat sheets. If you can just quickly go to them, our geopolitical cheat sheets, the Iran conflict, the oil price on here, and then if you go to the next slide, there's our thoughts on tariffs, the UK economy and fiscal situation, obviously very interesting there, and how we're positioned in the UK. And then a final slide on AI, cryptocurrency, and gold. And with that, we are ready to take any questions and do a Q&A session.
Thank you, James. Apologies for losing my stride a little bit earlier. Somebody kept calling me, and I couldn't turn it off. So just a few questions that we are looking at. Do you believe individual investors should be taking any direct action as a result of the situation in Iran, please? It's a good question, but it depends on how you are positioned going into this. Okay, obviously bonds are bearing the brunt, but you have to see at the wider picture. We will not be taking any significant action in our portfolios unless something dramatically changes in the next few days. Right now, we are in sort of not wait and see mode. Rather, we feel we are well positioned for this externality even. It depends on how your portfolio is built. I'm afraid no one can really tell you something more about it. I don't know
George,
if you have
George, I
yeah.
can just jump in on that one as well. Obviously, from our point of view, if you are in the right level of risk portfolio, the current moves hopefully should not be at the level that get you concerned and make you feel you need to leave the market. Because as we all know, staying in the market, being invested for the long term is the best way of ensuring that your wealth increases over the long term. So if you are in that right level of risk, hopefully this volatility we've seen recently is something you should be comfortable investing through.
Where can we invest for long term now that the US is unreliable and the oil supply is in chaos, which makes traditionally good and safe choices no longer what they were? To be sure, we don't subscribe necessarily to the view that the US is unreliable. In fact, markets have put money back into the dollar. The whole sell America trade has been reversed. But you are right. What you might think as a safe asset can be less safe. Look at bonds, look at gold. Again, the answer is in a balanced portfolio with active management. The whole point of active management is that we recognize that what's on paper safe might not be, or historically safe might not be as safe. And then you make adjustments which are either tactical if you feel this is a short-term issue, or strategic if you feel this is a longer-term issue. Again, I'll pass the baton back to James if he has any further thoughts, but it does depend on who your manager is. It does depend on whether they're doing a good job monitoring those risks and adjusting the risks within the portfolio.
I think that George makes a good point. A strategic asset allocation over the long term that is diversified across asset classes is showing its importance right here. So you can't rely on one thing, but if you've got various different ways of diversifying, as we've added absolute return, as we've got energy, those are the things that are going to help ensure that you have some sort of ballast in the event of an equity sell-off. On the
Um,
point of US being less reliable, I think as a team we don't really subscribe to this. From certainly from an investing perspective, I think we all appreciate the current administration is, let's say, unpredictable, but the current administration will be there for another 2.5, 3 years. We don't know what we're going to see beyond that. At the same time, as we mentioned, we actually went overweight the US. We've just found the right areas within the US to invest in, where there is support across the aisle to in particular areas like utilities. So it's not the case that the US as a whole is unreliable. You just got to find the right pockets of investment where earnings are expected to come through.
um, I don't think we have received some further questions, so we'll try to get back to people as soon as we can. Thank you for your time today. And we'll see you again in the next webinar, which should be in around 2 months' time. Thank you very much.
Thank you very much, everybody.